Hello, everybody. I'm Michael Smith, and we've had 3 weeks with no bank collapse. Nice. Welcome to the Lowdown. Hey everybody, I'm Michael Smith. Welcome to Lowdown. Today joining me is Kevin Lenox. And Kevin, I just mentioned 3 weeks and no bank collapse. What are your thoughts on this so far?
It's been interesting, hasn't it?
Yeah, it has.
So just as an update, a bank called Western Alliance just came out with an earnings report today, and they refused to talk about their deposit balance.
Oh, of course.
Down 16%.
Wow.
So I think this is a rolling story.
Okay.
It's not necessarily over. And the next issue we're all going to be talking about is the loan books. You know, previously this started with the asset liability mismatch, which I think you went through on a prior show.
Yeah, yes.
So there's not so much concern now about that. Now it's about what's the quality of the loan growth.
Well, maybe break that down.
Each bank has its own kind of niche exposure.
Okay.
So we're all going through that right now. But what's interesting is that of the commercial real estate, $2.6 trillion, small banks own 1.8 trillion of that.
Wow.
Almost 70%.
Wow.
So as you know, things are getting tighter here. And with all the boom after COVID now, commercial real estate and the derivatives tied to it could be the next shoe to drop. And then that could be another wave through the banking sector.
So that's probably the next big story. I mean, is there any things or any particular banks out there right now that are facing the biggest exposure, or do we know of that just yet?
I don't think we're supposed to go through the individual names here.
Yeah, well, that's true. Okay.
Feel free to reach out to us individually. But
yeah.
So what's really developing right now is a tightening of lending standards.
Okay.
Because now counterparty risk, everything is being questioned now. Mm-hmm. So banks had already been tightening lending standards. I want to tell you, of all the different leading indicators, the one that never gets it wrong is tightening lending standards. And conversely, when they start to loosen again. So the last report, 45% of banks were tightening lending standards for commercial and industrial loans.
Yeah.
That was before all this bank news started to drop. So that number is going meaningfully higher.
Sure.
So, guess what? We've got about $1.6 trillion in commercial real estate loans that have to be reset over the next 30 months to 3 years, moving from about 2.2 to 4% to 5 to 10% in an environment with tighter lending standards, less liquidity, and more than likely lower values.
Well, in the past, when you've seen tighter or lend standards that you've seen like this, and especially now, think about it. We're going to April. We're in the spring. This is the big time for the housing market, right? I mean, so this is definitely going against that. But when you see tighter lender standards, typically a recession is followed after that, right? We start to hear about the word recession, and I mean, you've listed commercial real estate. You got home builders. You've got industrial. So pretty much just about everybody's tightening up. This does not look well for the second half as far as looking at GDP, correct?
Right. Yeah. And so, as you know, I talk a lot about financial conditions and credit, and people have been looking at these financial conditions indices, which has a big component in the high yield market. Mm-hmm. And a big, part of the bullish thesis is, we'll look at high yield. If there was a real problem, we'd be seeing that really underperforming, and those spreads over treasuries would be really jumping, and they're not. So kind of what's happened is, every cycle is different.
Sure.
Right? So bombs don't fall in the same crater twice.
Exactly.
They fix the problem, make sure that doesn't happen again, but the risk oozes elsewhere.
Sure.
So what's happened is the high yield market is stronger than it was before. And few of the reasons why is that a lot of the smaller companies, the lower tiered credit, have moved over to the leveraged loan market.
Okay.
Where it's grown to be just about the same size as the high yield market. Mm-hmm. And get this, 85% of those loans are what they call covenant light. Okay. Which means there aren't real parameters if things start to go bad. So if you can go from the high yield market where there are more terms and structure that will constrain things in a tough environment, you go to the leveraged loan market, and a lot of that goes away. And there was so much money that just would not deal with 1-2% bond yields, and where can I go elsewhere for higher yields? So commercial real estate and leveraged loans took out a lot of money at the bottom of the rate cycle, and now that, and those two could be 1-2, but that's going to be an overhanging problem for the economy going forward.
So, for our listener, and maybe you can kind of explain this question, and I've been hearing, through media and et cetera, but, when you start hearing mortgages, the first flashback, and I think many listeners, is 2008, right?
Right, sure.
How is this different? Are we in a better position to maybe backstop this? But I mean, how do you feel we're positioned now? Or maybe how is this different or similar than 2008?
Sure. So the larger banks are much stronger, much less leveraged than they were back in 2008. And they own really a very small part of the commercial real estate loan market.
Okay.
So they're really not as impacted here. The problem is with the regional and the community banks. So Janet Yellen has done a lot of work to try to calm nerves.
Has she?
Done a lot of work.
Okay.
I was gonna say,
I was waiting for a little sarcasm there, but
so I was talking to a client yesterday, and he talked about a friend of his owns a small, mid-sized business.
Okay.
And all of his business accounts are with a community bank, and he doesn't know what he should do. And it's like, I'm not protected here. This bank is not too big to fail.
Yeah. Well, I mean, you got to be under FDIC. That's the number one thing. You need to be under FDIC limits.
But business accounts aren't going to be.
Yeah.
They're all going to be, not all, but a lot.
Sounds like you need to diversify and maybe have another bank or two.
Or 5.
Yeah. Well, I mean, look.
Or 10 for a lot of companies. So this is something that's going to have to be addressed. And it sounds like it's not going to get addressed until there are another couple of banks to drop. Because if you're running your business, then if nothing else, you could have a delay in funding, making payroll.
Yeah.
Even so, if asset deposits start moving to other institutions, that's going to kill that bank's opportunity or even willingness to make loans. So there's more work.
Well, if you're Janet Yellen or if you're the Fed right now, you want to get as fast as possible to contain this, because you have another bank or two, and the perception at that point is, well, the Fed is not able to contain this. Then you got a real problem on your hands.
So you really have to go through Congress
to
change the FDIC limits, and unless things get ugly, if you remember when Lehman went down,
I sure did.
The Freedom Caucus right now is not going to approve that. Changes to FDIC. They'll call it a bailout. And so something will have to break before we get to that point. But something really needs to be done, because that's an unaddressed big issue. And I think left unattended, you're going to see more deposit migration from the small banks to the much larger banks, especially on the business side.
Yeah.
More individuals they have money with. Other institutions.
Well, you look at other people, you look at businesses in other countries, they're used to, currency runs, they're used to banks in this situation. I mean, they have different bank accounts, they're diversified. I mean, we've been really at a luxury for many years to not ever think that could happen. But I don't think anyone needs to go excessively crazy here. We don't want to add to the problem. But yeah, if you're a large business and you got X amount of dollars in a bank, it's over to FDIC, you might want to diversify to some degree. So I think that's probably good advice. Well, so speaking about which, I mean, all this puts pressure on the Fed. What are some other things right now? I know we've had some jobs numbers, we've had some employment numbers. How is that playing into what the Fed is doing and potentially what the Fed may have to do?
So the Fed got something of a wake-up call. They'd been raising rates, and they kept talking about this very strong labor market.
Sure.
And they're looking at, as we've talked about many times, more backward-looking data.
Backward-looking data.
If you look at, and using government data, just the number of full-time jobs, it's unchanged over the past 12 months.
Yeah.
And if you look then at the business surveys, so the ISM surveys, PMIs, business, manufacturing and services, it's pretty much been neutral, just slight modest growth overall over the past 6 months. Actual contraction in manufacturing, but a little bit of a pickup in services. But the pattern doesn't look anything like it did, say, late 2020 through early 2022.
Okay.
So that has moderated. And then if you look at companies like Robert Half, big staffing firm, Their stock price, that does not indicate a hot job market.
Yeah.
Indeed, who advertises everywhere,
Yep.
they just did a big layoff. So I think when push comes to shove, the labor market is not as tight as the Fed thinks it is. And I think the rates market is adjusting to that. And you've got a Fed funds rate at 5%, and you've got a 2-year Treasury at 3.7. The market is saying the Fed is done. They have overcooked the ribeye.
Well, and so last week I ended the lowdown by saying, if you look at the Fed forecast, which we know have not been great, they indicate they're going to keep kind of moving. Putting things, yeah, they're terrible, right? I said, couldn't hit the barn with a shotgun, right? So, but I said the bond market is definitely one that's always been precision. And what I'm hearing you say kind of confirms that. I mean, the bond market is telling you the Fed's got to stop or potentially reverse what they've been doing. Is that kind of what you're seeing?
Yeah.
Okay, and are you seeing that?
They're on pace to break something.
And that's looking at probably second half of this year, according to what the bond markets are pointing out, correct?
Right. Yeah, we went from forecasting it within the Fed funds futures market, forecasting 6% on Fed funds by the end of the year, to now 85 basis points in cuts by the end of the year.
So in your opinion, Kevin, what gets Jerome Powell's attention to actually finally look at this? I mean, I think everybody sees it. Everybody's looking at this forward. The bond market's telling you. But when you hear the Fed speaking, Jerome Powell speaking, he acts like, nope, he's going to keep focused on the inflation. But what do you think's the one thing that makes him adjust or change?
So I think he hedged quite a bit at the last press conference, which was after several of the bank failures.
Okay.
And he stated for the first time that the threat to potential instability on the bank side could substitute for rate hikes.
Okay.
And that's kind of why we had the rally since then.
Yeah. Okay.
So kind of code for we're probably about done here.
We're about done.
We'll react if we need to.
Yeah.
And what was important, what the gold market took from that was we always wanted to know, push comes to shove, do you fight inflation or do you quit that fight early if any financial instability risk comes up?
And that's kind of what...
And that's what he's going to do every day.
Yeah.
They will take their chances with
you.
Inflation, but protect financial stability.
So it's almost like basically, let's keep pushing things higher. The first one broke, we contained it. Let's see if something else breaks. We're ready to step in. That's kind of the mentality we're seeing right now. It's just, let's just let something break. We'll come in and try to fix it. And then maybe push it, or at some point, we're going to backtrack.
He doesn't want that. They've had so many hits to their credibility.
Yeah. Oh, yeah.
He does not want to go down. That is Jay Powell. Does not want to go down as another Arthur Burns.
Exactly.
Who was head of the Fed back in the early mid-'70s when inflation really picked up, and they stopped and started, and as far as fighting inflation, before Volcker came in and put down the hammer.
Yeah, well, he wants to be Volcker, and I mean Jerome Powell.
He kind of wants to be.
He wants to be, but I don't think that's going to be the case.
There's a dove inside him as well.
Very true, very true. Well, I want to kind of maybe wrap up, and you've definitely been tight with the oil markets. You understand the oil markets. You've been in the energy guy for a long time. What do you make of the production cuts by OPEC? Why do they do this? What is your thoughts on that?
We've had a bet who would cut first, OPEC or the Fed.
Yeah,
and OPEC won.
Yeah, I would have probably picked OPEC as well.
So OPEC was very frustrated with Saudi Arabia, apparently, most particularly, in the decline in oil prices and the heavy short position that had almost record short position in oil by the global macro guys, which are saying slow down in global economy. This is going to get worse before it gets better. Yeah. Therefore, oil trades more on the perception of future demand than it does this structural supply deficit.
So this is their attempt to try to get ahead of that, basically.
Offset it, yeah.
Yeah, okay.
They thought oil was too low. The short sellers had taken too big of a position, and so on a Sunday, they come out and announce not just a cut in supply, but a coordinated cut in supply. And that caused oil to jump instantaneously. And now the issue for the Fed is Oh, no.
All right, explain.
Because he had talked about, I think in the previous, not the latest one, but the previous press conference, he mentioned disinflation apparently 12 times.
Yeah. Yeah.
And that has been the hope, and that was the big driver of the big tech rally that we saw.
Maybe explain.
So first quarter, S&P was up 7%. 5 tech stocks accounted for 100% of that return. This is, I think, through the 30th is when I ran it. So the other 495 stocks were basically zero.
Yeah.
Everything that worked well in the second half.
So the breadth is basically shrunk in the market.
Everything that worked really well in the last half of last year got smoked.
Yep, sure did.
In the first quarter of this year, and the worst did turn to the best on the expectation of the disinflation theory or the soft economic landing thesis.
Explain
the ever-changing narrative.
Explain disinflation for those listening that may not know.
So a slowdown in the rate of price increases.
Okay.
So we had been running 5.5%, 6% plus year-over-year inflation. So we have a disinflation case building anyway.
Sure.
Just because of base effects, year on year. The right way to do it is take the last 3 months and then annualize that versus comparing this year versus last year is the better way to look at it. But our forecast has been for inflation to be sticky and at a higher level than it was pre-COVID. Because, we ripped up all the supply chains, global supply chains.
Yeah, we disconnected everything.
We are bringing things back home, and labor has gotten more of an upper hand. Fiscal policy has certainly added a lot of inflation to the system structurally.
Yep.
And now we get a bounce up in oil prices.
Okay.
So it complicates the Fed's job even more now. So we could have slowing growth at the same time we have persistently sticky inflation. And that's a problem.
That is a problem. Well, and I'm going to kind of wrap things up. So, as an investor, what are some of the things you should be doing in terms of your portfolio, in terms of, kind of protecting as we move into this disinflationary period and potentially some change in Fed policy towards the end of the year?
My thesis, and it's been this for like almost 2 years now, is buy quality companies. Large companies, strong balance sheets, history of raising their dividend, that have pricing power in this environment and can actually gain market share versus their competitors. Those companies continue to outperform the S&P 500. You can do it through an ETF. I personally think it's better through an individual stock selection strategy, but that type of structure is what you want to have on the equities. When you're very late stage of the business cycle, borderline recession, you have to focus on that type of a company and those that are shareholder friendly. So I'll throw in one example of a cyclical company, FedEx. They announced they're laying off 12,000 people, and they turn right around and announce a 10% stock dividend. The stock's at all-time highs.
Wow. All right. So those are good examples. But I agree with you. I mean, again, right now it's time to focus on quality. We got a lot of things we're transitioning to, a lot of uncertainty, which is now, I think, being kind of, priced in right now. I mean, we don't know what the Fed's going to do. We don't know what all these other, issues are going to at least, force the Fed to do. So it's creating a lot of uncertainty, which the markets don't like. So quality is always best to be in as you're waiting kind of the storm to pass.
Yeah, the range of potential outcomes has widened.
Yeah. Okay. Well, Kevin, look, always great to have you on the show. I think these are great points, and we'll have you on soon. Thanks for joining us.
Sure.